How to start investing with $100. Most people believe investing is only for the rich. Now that's a myth. Thanks to modern investment platforms and fractional shares, anyone can start investing with just a small amount. You can start building wealth today with just $100. In this video, we will break down the steps to turn that $100 into long-term growth, even if you're a beginner. Stay tuned, because by the end of this video, you'll have a simple, actionable plan to start investing today and make your money work for you. Step 1. Define your investing goals. Before you invest, take a moment to ask yourself, why am I investing? Your answer will shape your investment strategy. Some people invest to build long-term wealth, while others seek to generate passive income, and some just want to experiment with the market before committing more money. If your primary goal is long-term growth, index funds are among the safest and most effective ways to invest. These funds track the performance of a broad market index, such as the S&P 500, allowing you to gain exposure to hundreds of companies at once. This diversification helps reduce risk while still providing solid returns. According to a report from Morningstar, the S&P 500 has delivered an average annual return of about 10% over the past century, making it a reliable option for steady wealth building. For those looking to generate passive income, investments like dividend stocks and real estate investment trusts, REITs, are excellent choices. Dividend stocks are shares of companies that regularly pay out a portion of their earnings to investors. Over time, these payouts can accumulate, especially if you reinvest them. A study by Hartford Funds found that reinvesting dividends has contributed to nearly 40% of the S&P 500's total returns over time. Step 2. Where to invest your $100. But the question is, where you should invest your $100. Now that you've defined your goals, let's explore the best platforms and accounts to help you get started. Number 1. Index funds and ETFs. Best for beginners. If you want a simple, low-risk way to start investing, index funds and ETFs, or exchange-traded funds, are excellent choices. These funds are made up of many different stocks, so instead of buying shares in just one company, your money is spread across hundreds or even thousands. This diversification reduces risk while still allowing for solid long-term growth. One of the biggest advantages of index funds and ETFs is that they have low fees compared to actively managed funds. Research from Morningstar shows that funds with lower fees tend to outperform more expensive ones over time. Number 2. Fractional shares. Own a piece of big companies. Many well-known companies have stock prices that are out of reach for small investors. For example, Amazon stock has traded at over $3,000 per share, making it impossible for many beginners to buy a full share. However, with fractional shares, you can invest just a small piece of a stock instead of purchasing a full share. This makes it easier to invest in top companies like Apple, Tesla, and Microsoft without needing a large amount of money. Platforms like Robinhood, M1 Finance, and Fidelity allow you to invest in fractional shares with as little as $1. Number 3. Crypto and alternative investments. If you're open to higher risk investments, you might consider cryptocurrency and alternative assets. Crypto has created massive wealth for early investors, but it's also extremely volatile. The price of Bitcoin, for example, has seen dramatic swings from just $100 in 2013 to over $60,000 in 2021 before crashing to lower levels. To get started, platforms like Coinbase, Binance, or Kraken allow you to buy crypto with as little as $10. If you decide to invest in cryptocurrency, focus on well-established assets like Bitcoin or Ethereum rather than speculative coins with little history. Number 4. Robo-advisors. Hands-free investing for beginners. If you don't want to research stocks or funds yourself, a robo-advisor can handle everything for you. Robo-advisors use artificial intelligence and algorithms to automatically invest and manage your money based on your risk tolerance and goals. These platforms build diversified portfolios for you, balancing stocks, bonds, and other assets to match your investment style. Popular options include Betterment, Wealthfront, and Acorns. Step 3. Making your first investment. Now that you've chosen where to invest, it's time to take action. The hardest part of investing is often getting started, but once you make that first move, it becomes much easier to stay consistent. Here's how to invest your $100 and set yourself up for long-term success. Number 1. Set up an account on your chosen platform. Before you can invest, you need an investment account. This could be a brokerage account, a crypto exchange, or a robo-advisor, depending on where you decide to put your money. Each option serves a different purpose, so choosing the right one depends on your investment goals. Most platforms make signing up quick and easy. The process usually takes just a few minutes and requires some basic personal information. You'll typically need to provide your name, date of birth, and address, as well as link a bank account or payment method to fund your investments. Once your account is set up, you may also need to choose between an individual investment account, a retirement account like an IRA, or a managed portfolio. For stock and ETF investors, platforms like Vanguard, Fidelity, Robinhood, and M1 Finance offer simple and beginner-friendly options. If you're investing in crypto, exchanges like Coinbase, Binance, and Kraken provide easy access to digital assets. And if you prefer a hands-off approach, robo-advisors like Betterment and Acorns will automatically manage your investments based on your goals and risk tolerance. No matter which platform you choose, the key is to start as soon as possible. The earlier you invest, the more time your money has to grow and compound over time. Number 2. Deposit your $100 and choose your investment option. Once your account is set up, the next step is funding it. Most platforms make this simple by allowing deposits through bank transfers, debit cards, or even PayPal. Some investment apps let you start with as little as $5 or $10, making it easy to begin without a large upfront investment. Now comes the exciting part: choosing what to invest in. Your investment choice could align with your financial goals. If you're looking for steady long-term growth, a low-cost index fund or ETF like VOO, S&P 500 ETF, can be a strong option. These funds track the overall market and have historically provided consistent returns over time. If your goal is passive income, consider REITs, real estate investment trusts, or dividend-paying stocks. These investments generate regular cash flow, making them great for those who want to earn money while holding on to their assets. If you're comfortable with higher risk and potential reward, you might invest in fractional shares of individual companies or put a small amount into cryptocurrency. While these investments can be more volatile, they also offer the potential for significant gains. One of the best ways to manage risk is through diversification. Instead of putting your full $100 into a single investment, consider spreading it across multiple assets. For example, $50 into an S&P 500 ETF for long-term stability, $30 into a dividend-paying REIT for passive income, $20 into Bitcoin for high-risk, high-reward potential. By diversifying, you're not relying on just one investment. If one asset underperforms, the others can help balance it out. This strategy helps protect your portfolio while still allowing for growth. Number 3. Enable auto-investing for long-term growth. One of the best ways to build wealth over time is to invest regularly, not just once. This strategy, called dollar-cost averaging, means you invest small amounts consistently, regardless of market conditions. Why is this important? It removes emotion from investing. Instead of trying to time the market, you just keep investing steadily. Research shows that investors who invest regularly often outperform those who wait for the perfect time. Most investment platforms offer an auto-invest feature, allowing you to automatically deposit money into your portfolio every week or month. Even if it's just $10 or $20 at a time, it adds up. For example, if you invest $100 per month into an S&P 500 index fund, you'd have around $21,000 after 10 years, assuming a 10% average return. Over 30 years, this could grow to over $200,000, all from small, consistent investments. If you found this video helpful, hit the like button, subscribe to our channel, and share this with anyone who's just getting started with investing. Thanks for watching, and we'll see you in the next video.